What if the most consequential buyers of silver in the world have been quietly accumulating every single month for 19 consecutive months? Through a war, through crashes, through ceasefire collapses, and almost no one watching this morning's price move has any idea they exist. Two markets are operating simultaneously inside the price of silver right now, and the overwhelming majority of people watching the number on their screens this morning are seeing only one of them. That number, it must be said, is arresting. Silver futures surged on Monday, June 15th, opening the week at $68.90 an ounce before climbing with mounting conviction, $70.75 by mid-morning, $71.71 by late morning at the spot market, settling near $70.81 by early afternoon. On Tuesday, June 16th, the metal is trading in the $69.91 to $70.57 range as markets absorb the full implications of what just happened diplomatically. In 4 trading sessions, silver moved from roughly $64 to above $71, an 11% advance compressed into less than a week, the kind of trajectory that forces even the most disciplined observers to sit up straighter and recalculate. The catalyst is not obscure. The United States and Iran have reached a peace deal, confirmed Sunday by Pakistan's Prime Minister Shehbaz Sharif, affirmed by Iran's Deputy Foreign Minister Kazim Garibabadi, and announced by President Trump himself. The agreement establishes a 60-day ceasefire, a memorandum of understanding between Washington and Tehran, and the immediate reopening of the Strait of Hormuz to international shipping. The formal signing ceremony is scheduled for this Friday, June 19th in Switzerland. What makes this diplomatic moment categorically different from every prior headfake, the January reversal, the March collapse, the productive talk sessions that dissolved within hours, is the architecture of confirmation surrounding it. Previous announcements involved Trump making statements that Tehran subsequently denied. This one carries Iran's own foreign ministry confirmation, Pakistan's mediating prime minister on record, a scheduled signing venue, and a named date. The language has migrated from could be reached and conceptual to a signed memorandum with a formal ceremony 3 days away. 3 consecutive sessions of rising closes, each one larger than the preceding one, is the market's own annotation of that distinction. A single morning spike followed by a fade is how the metals market registers a rumor. 4 consecutive days of higher closes, each built on a real diplomatic development rather than a speculative bounce, is how it registers something it believes. Where are you watching from today? Drop your city or country in the comments. It genuinely matters to understand who is following this story and from which corner of a very consequential planet. Silver, it is worth remembering, began 2026 trading near $71 an ounce. On January 29th, it reached a nominal all-time high of $121.67, the most expensive an ounce of silver had ever been in recorded history. What followed was an uncommonly severe correction. Iran's war intensified. Oil surged. Inflation concerns anchored the Federal Reserve in place. Ceasefire promises made in January and March each collapsed within days of their announcement. By the time the market had fully repriced those disappointments, silver had fallen to below $64 an ounce, a nearly 47% decline from its January peak within a single calendar year. The round trip from $71 to $121.67 to $63 and back towards $71, all compressed into 6 months, is precisely the kind of price history that convinces a great many investors that silver is simply too volatile to hold with any meaningful conviction. That conviction, this video will argue, is almost certainly mistaken. Not because volatility is pleasant, which it emphatically is not, but because the price went on that roller coaster while the physical fundamentals sat almost entirely still. Every one of those violent swings, the run to $121.67, the crash to $63, the recovery back toward $71, happened against the backdrop of the same structural supply deficit, now in its 6th consecutive year. The Silver Institute's World Silver Survey 2026, released April 15th, confirmed a projected shortfall of 46.3 million troy ounces for this year alone, widening from 40.3 million ounces in 2025. Since 2021, the cumulative drawdown from above-ground stocks has reached 762 million troy ounces, a number so large and so sustained that it has ceased to feel real to most observers, which is itself a form of market inefficiency. The loud market, the one that moved 11% in 4 sessions because a war that has disrupted roughly 20% of global oil and liquefied natural gas flows appears to be ending, deserves serious attention precisely because it just delivered the kind of unambiguous confirmation that has been conspicuously absent since late January. With Kevin Warsh opening his very first Federal Open Market Committee meeting today, June 16th, with the press conference set for Wednesday, June 17th, and with oil markets already falling sharply on Strait of Hormuz reopening expectations, the macroeconomic tailwinds behind this week's move are stacking rather than competing. The Federal Reserve is expected to hold rates steady at 3.50 to 3.75%. 97.4% of futures traders, as measured by the CME FedWatch tool, anticipate no change. But Warsh's inaugural press conference language on Wednesday, particularly any acknowledgement of the easing energy inflation pressure created by the ceasefire, could add another leg of institutional enthusiasm beneath what is already a technically meaningful breakout. If you find yourself wanting to understand these markets more deeply, the structural forces, the sovereign decisions, the data that does not make headlines, consider subscribing. The quiet market, which is what this video is really about, rewards patient attention far more than any single week's price action. It is the kind of content that compounds in usefulness the longer you follow it. But the loud market has done something important this week. It has produced the first sustained, multi-session, catalyst-backed rally since January. It has reclaimed a technically significant level, the $71 threshold that separates this correction's bearish and bullish technical scenarios, the level above which chart momentum shifts from ceiling to tailwind. And it has done so with 3 consecutive days of confirmation, rather than a single spike, which is the difference between a dead cat bounce and the beginning of something structurally meaningful. The loud market, in short, has finally spoken clearly. What it has said is, the geopolitical premium that drove silver from $71 to $121.67 in January is beginning, cautiously and provisionally, to return. Whether it sustains that statement depends on whether Friday's signing in Switzerland holds, whether Warsh's language on Wednesday is read as accommodative in the context of falling energy costs, and whether the metal can hold $71 through a week that contains 2 significant institutional catalysts. There is, however, a second market operating underneath the loud one. It does not move on ceasefire headlines. It does not react to what any president posts on social media. It does not care whether the Federal Reserve holds, cuts, or raises rates at any given meeting. It is the market of who is actually buying silver and gold in what quantity, through what channel, and for what reason. And the data describing that market, published 8 days ago by one of the most authoritative research institutions covering precious metals, reveals something that almost nobody discussing this morning's price movement is talking about. The People's Bank of China added 9.95 tons of gold to its official reserves in May 2026, a figure confirmed by the State Administration of Foreign Exchange on June 8th. This extended the PBOC's unbroken buying streak to 19 consecutive months, now the longest continuous accumulation period since the institution began publishing standardized monthly reserve disclosures in 2015. Total declared Chinese gold holdings now stand at approximately 2,331 tons, with the nation's foreign exchange reserves simultaneously reaching $3.44 trillion, the highest level since November 2015. The pace of accumulation has, if anything, been accelerating. April's addition was 8 tons, the largest single-month purchase in over 16 months. May's 9.95 tons extended both the streak and the velocity. 19 months. Through every conceivable market condition, through gold's surge past $5,000 per troy ounce, through the spring's painful pullback, through the entirety of the Iran war, through a credit downgrade of United States sovereign debt, through 2 complete boom and bust cycles in the metals themselves, the People's Bank of China's answer every single month has been identical: buy more. In reserve management circles, that kind of consistency is not sentiment. It is structural policy. It reflects an institution operating on a 20-year horizon, making a determination that the international monetary system is undergoing a reorganization whose implications require a different reserve composition than the one that served the prior era. At precisely the same moment, the World Gold Council's monthly China update documented something that appears, on its face, to contradict the PBOC's behavior entirely. Gold withdrawals from the Shanghai Gold Exchange in May totaled 64 tons, down 38% month-over-month and down 36% year-over-year, making it the weakest May for Chinese wholesale gold demand since 2010. Chinese gold exchange-traded funds registered their first monthly outflow since August 2025, shedding $1.2 billion in a single month and breaking an 8-month streak of inflows. Persistent weakness in the gold jewelry sector, affordability pressures at elevated prices, and the attention-pulling effects of a recovering equity market combine to keep retail buyers cautious. Consider the extraordinary juxtaposition those two facts create. In the same month, China's central bank purchased gold at its fastest pace in 18 months, while Chinese retail investors, jewelers, and ETF holders pulled back at the fastest pace in 16 years. The PBOC and the retail Chinese investor were, in May, doing opposite things. The PBOC was accelerating. The retail investor was retreating. Those two actors were responding to entirely different sets of signals. Retail investors respond to price momentum and headlines. When gold and silver pulled back from their January highs, when the Iran war made every headline more alarming than the previous one, when ceasefire promises kept disintegrating within days of their announcement, retail investors did what retail investors characteristically do at exactly the wrong moment. They became cautious. Chinese jewelers reduced restocking orders. Chinese ETF holders redeemed $1.2 billion in a single month. Wholesale gold withdrawals hit their weakest May reading since 2010. Sovereign buyers respond to conditions that do not change month to month. The dollar's share of global reserves. The trajectory of American fiscal deficits projected to approach 9% of GDP before 2035. The precedent established when Western sanctions froze $300 billion of Russian sovereign reserves in 2022. A decision that demonstrated to every central bank outside the Western alliance that dollar-denominated assets carry a form of counterparty risk that had been previously theoretical. None of those structural conditions reversed because Iran and the United States announced a ceasefire. None of them reversed because Chinese retail sentiment soured in May. The PBOC's 19-month streak did not pause for a single month despite all of it. Think carefully about the asymmetry that creates. Every month that retail demand remains soft is a month in which the marginal ounce of precious metal that comes onto the market does not get absorbed by jewelers or ETF buyers, leaving more available for the sovereign buyer who shows up every month regardless of price, regardless of headlines, regardless of whether the mood in the physical market feels bullish or bearish. A sovereign buyer accumulating into retail weakness is, in the most precise sense, absorbing the metal that nervous retail money left behind. The PBOC's largest monthly purchase since December 2024 happened in the same month that Chinese wholesale demand hit its weakest point since 2010. That is what patient, structurally motivated accumulation looks like when it is operating without constraint. Here is why this matters specifically for silver, and why it represents the real story underneath this week's ceasefire rally. Every structural force driving China's 19-month gold accumulation streak, anxiety about dollar reserve concentration following the Russian asset freeze, the search for assets with no counterparty risk following America's credit downgrade, the desire to reduce exposure to a currency whose issuer is running structural deficits measured in trillions, applies with equal or greater force to silver. Russia's federal budget for 2025 through 2027 explicitly allocated sovereign funds for silver acquisition alongside gold, platinum, and palladium, the first such allocation in the modern era. India has made parallel accumulation decisions. These sovereign silver purchases do not appear in monthly World Gold Council reports with the same disclosure timeline as PBOC gold holdings, because silver sovereign acquisitions are not subject to identical reporting requirements. They are happening in the same quiet market, with the same strategic motivation, simply without the 19-month paper trail. The divergence between what the People's Bank of China is doing and what retail sentiment is doing is not a contradiction to be explained away. It is a signal to be read carefully. Institutional buyers with multi-decade horizons and sovereign buyers repositioning national reserves for a world in which dollar hegemony is contested do not calibrate their decisions to any given month's price action. They calibrate to conditions that will persist for decades, and those conditions have not changed this week, last month, or since January's all-time high. Here, then, is the question that connects everything this week's events have revealed. Why would sovereign buyers continue accumulating precious metals at record pace during exactly the months when retail investors, per the World Gold Council's own documented data, were pulling back at the fastest rate in 16 years? The answer is that these two categories of buyer are not merely responding to different signals. They are operating in different temporal frames entirely. The retail investor's time horizon, whether consciously acknowledged or not, is typically measured in months or at most a handful of years. The central bank reserve manager's time horizon is measured in decades. These are not variations on the same framework. They are categorically different frameworks applied to the same instrument. A price pullback from $121.67 to $64 over 5 months is a catastrophe for the retail investor, whose emotional commitment to the thesis was established near the January peak. For the reserve manager operating a 2,000-ton and growing gold allocation on behalf of a sovereign state, a 5-month price correction in a volatile commodity is, in the technical language of their profession, noise. The significance of silver's supply structure is that it operates on the reserve manager's time frame, rather than the retail investor's. The 762 million troy ounces of cumulative drawdown from global above-ground stocks since 2021, confirmed by the Silver Institute's World Silver Survey 2026, did not pause during silver's fall from $121.67 to $63. The sixth consecutive annual supply deficit, projected at 46.3 million troy ounces for 2026, does not care what the price did in any given month. Mine production, which takes 5 to 10 years to develop and bring online, cannot respond to a short-term price correction the way equity markets can respond to a policy announcement. The structural supply shortfall persists, whether the emotional temperature of the retail market is ebullient or despondent. And this is precisely the environment in which the connection between the loud market and the quiet market becomes analytically decisive. This morning's move, the recovery from $63 back above $71 on a legitimate, confirmed, multi-party diplomatic breakthrough, is not happening in isolation. It is happening on top of a 19-month sovereign accumulation streak in gold, a parallel sovereign silver accumulation program in Russia and India, operating without equivalent monthly disclosure, a 6th consecutive year of physical supply deficit, and a Federal Reserve meeting whose press conference on Wednesday could provide the macroeconomic grace note that extends this week's rally into a sustained directional shift. What is required for a price to move the way silver moved on Monday is technically specific. Sellers must disappear faster than buyers arrive. The participants who were positioned short, who were betting that the ceasefire would collapse as it had in January and March, who were positioned for the bearish technical scenario targeting $64 and below, are now holding losing positions with no new bearish headline to justify maintaining them. Every short position that closes is, mechanically, a buyer. Monday's gap from $68.90 to $70.75 and beyond was therefore not merely new money arriving. It was old bearish money being forcibly extracted. At the same moment, the structural buyers described throughout this video were still present, unmoved, having never left, because their reason for being present has nothing to do with any given week's geopolitical outcome. Kevin Warsh's inaugural press conference on Wednesday, June 17th, is the week's remaining variable of consequence. With Brent crude already falling sharply on Strait of Hormuz reopening expectations, having been at its lowest point of the entire conflict even before Monday's announcement, the inflation argument that has anchored elevated rate hike probability is weakening in real time. The CME FedWatch tool shows a 97.4% probability of no change at this meeting, with 72 of 102 economists surveyed by Reuters expecting rates to remain unchanged through the end of 2026. But the press conference is not about what Warsh decides. It is about what he signals. If his language on Wednesday acknowledges that falling energy costs are meaningfully reducing inflationary pressure, the loud market gets another institutional tailwind layered directly on top of the ceasefire gains. If he sounds hawkish and discounts the geopolitical deflation, the market interprets that as a ceiling rather than a floor. The technical picture is specific about what this week's close needs to accomplish. The $71 level is the dividing line that technical analysts have identified between the correction's bearish and bullish scenarios. Below that level, every rally attempt gets sold by traders still positioned for the correction to continue. Above it, on a sustained basis, not merely an intraday spike but a closing basis, the chart's own momentum begins working as a tailwind rather than a ceiling. 4 sessions of higher closes, each one on a real catalyst, make as compelling a technical case as this market has presented in either direction since the January all-time high. Whether it is compelling enough to hold through Friday's signing ceremony and beyond is the question that the next several sessions will answer. But here is what this entire analysis has been building toward, and what the two markets together suggest about silver's longer arc. The loud market, the ceasefire market, the headline market, the market that moved 11% in 4 sessions, is real, and its near-term path matters. But it is the quiet market that is setting the floor. The PBOC's 19-month streak has been accumulating through every version of the noise, through the January peak, through the spring correction, through the months when Chinese retail investors were pulling back at a 16-year pace. The quiet market does not need any given week's headlines to justify its behavior. It has been behaving consistently because the structural conditions that explain its behavior have themselves been consistent. The moment the loud and quiet markets begin moving in the same direction simultaneously, which is, broadly speaking, what appears to be unfolding this week for the first time since January, the combination is not additive, it is multiplicative. Two buyer communities with entirely different motivations and entirely different time horizons, converging on the same instrument at the same time, are not simply twice as many buyers. They are two self-reinforcing feedback loops whose interaction can produce price movements that neither would generate alone. Watch whether $71 holds through this week's close. Watch what Warsh says on Wednesday afternoon. Watch for the next World Gold Council monthly update to see whether the PBOC's June purchase extends the streak to 20 months. Because that number, more than any single day's ceasefire announcement, is the one that tells you which market is genuinely setting the floor beneath this metal. The loud market tells you what happened today. The quiet market tells you where the floor is. Understanding both, together, is what distinguishes the investor who navigates this metal from the one who simply rides its volatility and wonders afterward what they missed. What do you think? Is this week's move the beginning of a sustained recovery, or another head fake that fades before the signing? Drop your view in the comments below. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.